Well, look, welcome to the latest LaingBuisson webinar. And I'm delighted to be hosting this webinar in partnership with Avison Young. The topic is the UK healthcare market review, which is something that we've been doing annually for many years. And it really is a unique example where we can get a snapshot of where the independent sector is at the moment. I want to start by turning to the polling and Q&A, and hopefully you can all hear me. There's a chat that's just gone up from Andrew Cox saying there's no sound coming through, but I hope that the rest of you can hear me. We use Slido really for two things. One is for polling and the other is for Q&A. So if I could just encourage you, if you have a browser or if you have a smartphone or a tablet, just go to slido.com, slido.com, or you could actually put in sli.do, it should work as well. And you'll come up with a page which should look a little bit like this, saying joining as a participant, enter event code. And all you have to do is type in the word healthcare and join the event. And hopefully you will end up with something that looks a little bit like this. You click on the Q&A to submit a question, and you just type your question in here and then press return or click on ask. Or alternatively, you click on the polls and you can participate in the polls. And there's a live poll running at the moment, which we'll turn to after we've gone through this. But I think the other key thing is you can upvote questions. So we've got a question that's been entered here. Is the NHS a true partner for the independent sector? If you've got questions for the panelists that you would like them to focus on, upvote those questions and they will come to the top of the list and then we can address them. So I'm now going to switch to the poll and see how we're doing. The question we've posed is, does NHS England's drive for integration create opportunities for the independent sector in health and social care? And we've got 33 people, 40 now who've logged in. And I think this is going to be a really interesting theme throughout what we're going to talk about this morning, this concept of integration and how that might happen, and whether that is an opportunity or not. And we can already see from the polling the split between yes and on the right terms. So we'll come back to that at the end and see whether, in fact, perspectives have changed as we listen to the speakers this morning. Just to set the scene, the UK Healthcare Market Review is actually now in its 32nd edition. So it's been published for many, many years. And one of the reasons is that it's effectively a market sizing and market overview, with that market size data shared with the Office for National Statistics. So the ONS can add the independent sector spend together with the NHS spend and local authority spend in order to come up with UK health and social care spending, which then gets benchmarked against other nations, specifically with the OECD, the World Health Organization, and Eurostat. The markets we look at are pretty extensive. The largest ones are the private acute medical market, health cover, so health insurance, care homes, adult specialist care, home care, children's services, and then others like dentistry, primary care, and IVF. And you add all those up, and this is a very significant part of the health economy. The report this year does reflect the impact of COVID on a number of these markets. And William in particular has been doing some excellent consulting work during lockdown with the local government association with Care England, with some really good insights. And also, this is a fascinating time because government policy and the NHS strategy is changing in real time. We ran a poll in one of our earlier webinars, and we said, what will be the biggest benefit of COVID? And interestingly, the number one was the real use of digital and data. The second one was more system funding. And the third one was better discharge of patients into social care from healthcare. We'll see today whether some of those predictions are borne out both by the audience and by our panelists. But we can certainly see there are some key themes that are emerging. In terms of the questions that you, the audience, posed to us before the webinar, I put them into three categories. The general one, where there are things like, how is mental health and well-being of staff being treated? How will the upcoming recession affect people's predictions on market growth? Specifically in healthcare, we've got how will the pandemic and the ensuing economic crisis alter independent healthcare? What's the opinion around cancer care in 3 to 6 months, given there's a surge in new diagnosis? And what will the dynamics look in 2021 when Mayo and Cleveland come on stream? In social care, there's some specific questions around property, which Iain will address, around the ranges of YP, years purchase for care homes, changes in planning consent for high street medical shops, whether we think that social care will be 100% funded and when, whether actually clients funded by local authorities will even exist in the future under the proposed reforms, and whether the government really believes in the concept of nursing homes given their current behaviour. So it's some quite sort of provocative questions there. It'd be interesting to see what people feel. Just in terms of setting the scene, we have seen deals during lockdown. Nordic Capital back in March bought Spa Medica, which is an ophthalmology clinic chain. Onyx bought Independent Clinical Services, which is the largest staffing business to the healthcare market. Northwest Healthcare Properties bought a portfolio of independent sector hospitals operated by Aspen Healthcare in August. And if you look at the pipeline it's building, but aside from the larger headline transactions, we've also seen day-to-day transactions achieved together, which is owned by AMP and active in the adult specialist care sector, acquired Montana Care in August, it acquired Progress Pathways back in May. The dermatology business, Skin, which is backed by Trispan Private Equity, bought the Mole Clinic in August. Bupa acquired CS Healthcare in August with 18,500 members to add to their health insurance business. So there's been a lot of activity on a day-to-day basis, and particularly in real estate, with the likes of Triple Point, Target, Civitas, Edificia, PHP, are all active in the property market. And then if we look at the pipeline, we've got Aspen for sale, Keys and Sandcastle in children's services, Priory and Consensus in adult specialist care, and then a pipeline of other assets which are due to come to market. So I think the market is very much alive and kicking. And I think that's reflected in this chart, which was put together by Ernst & Young and Apposite Capital, which really identifies where the COVID subsectors have been impacted and where they've actually had a relatively good COVID. So in terms of the COVID effect, at the top of the chart, it's actually COVID has been positive for the sector, and the long-term outlook is strong. So we're looking at the top right hand here, and you can see that things like children's services, diagnostics, digital health, specialist care, home care have all done very well, whereas elderly care and questionably private hospitals have done less well. And we'll examine those in more detail later. Just to finish, this was a very good chart that PwC presented at one of our earlier webinars, and it really looks at the speed of recovery. When lockdown ends, what's going to bounce back quickly? And at the top, it's very much a story of technology with telehealth and online pharmacies. But I think in terms of the provider side, adult specialist care, children's services, and home care are the three that will be most limited in the impact of COVID. And that's reflected in the pipeline of assets that I mentioned earlier. The ones that will rebound once we finally open up, vets, IVF, and dentistry, we're already seeing that, particularly with things like IVF and dentistry. And then the more gradual recovery in elderly care, and then more consumer electives like cosmetic surgery. So on that, I'd just like to welcome Iain Lock, who is going to start by setting the scene from a property perspective. Chris Day would have been with us and sends his apologies, but he has sent us a video message, which I will play. And then William will walk through the social care sector, where there are a lot of changes at the moment, and look at the various subsectors of that market and the impact of COVID. So on that, Iain, if I could turn over to you to walk us through the markets during a period of volatility.
Thank you, Henry. Morning to everybody. Can I just first say that we are very happy again to be sponsoring the review this year. We consider LaingBuisson Research to be the go-to place in the sector, and we are very happy to be aligned with that on a year-by-year basis. And I'm sorry we can't be hosting in Gresham Street and providing everybody with some coffee and a bacon butty, but the upside of that is that we have many more people on the webinar than we could fit into Gresham Street. And I was there yesterday, and the city, I have to say, is still a very, very quiet place. I will move straight on to the agenda because we don't have a huge amount of time this morning. And as William has said in the past, that everything that LaingBuisson does translates in one way or another into the marketplace. And you won't be surprised that the marketplace is what I will talk about, because that's what we do at Avison Young. I will, to those that don't know Avison Young terribly well, I will just outline what we do in the healthcare sector. But I'm going to spend a few minutes talking about the transactional markets, the valuation piece, what we're doing on the development consultancy side, and just a little bit on planning, because that is very relevant to everything that's going on at the present time. And then I'll just make a few closing remarks before I hand back. So very briefly, the team at Avison Young in healthcare is something like 60 strong across all of our. We cover the major surveying and planning consultancy practice, and you can see those disciplines at the bottom. If I've missed any of my colleagues off, I apologise immediately. But you will see the depth and the breadth of what we do, and we do cover all of that within the healthcare sector. And we cover private and NHS markets. I can see the next slide has come up just very slightly too early, but I just wanted to say that we have many of our consultants working in the NHS across trusts all over the UK. Certainly our building and project management and rating teams in particular. My piece of this business is valuation and transaction and general consultancy. And we spend a lot of our time in the residential care sector, whether that's nursing or residential care homes, extra care facilities, specialist facilities, and so on, private hospitals. And we also have a very large practice within the primary care sector. So I'll spend most of my time talking about those two sectors. We also increasingly do allied sectors where there's a large piece of property asset within it, such as dentists and day nurseries and vets. So thank you, Henry, if I can have or Jade, thank you, if I can have the next slide. So what has been happening in the transactional market over the last 6 months or so? Henry outlined a few moments ago that there have been a number of large corporate transactions within the sector generally. Within the property aligned parts of the market, we have in general seen something of a slowdown since March, although some transactions that had momentum pre-March have gone over the line. Not so much for primary care, which has held up incredibly well with government-backed income. And we have seen a significant number of individual deals taking place, many of them by us over the last 6 months, and we've got more to do before the end of the year. So there is demand for those assets. One of those is Terce-Monceau that you can see bottom right there. Generally good assets, let with government-backed rental income, of course, and yields we haven't seen move particularly. They're in the 4%. The last portfolio deal in March was PHP's acquisition of a BlackRock portfolio for about 47 million, I think 22 assets, sub 5%. So we're seeing that yield applied, but we haven't seen it since of any note, but the feeling is that yields haven't shifted at all. The residential care market is different. It isn't government-backed income, although of course there's the element of fee income from local authorities and so on. But this sector has been affected more by COVID quite clearly. Operators have been heads down dealing with operations, so haven't been thinking very much about transacting in the sector, buying or selling. So we are seeing a paucity of evidence come through at the present time. We have a number of transactions that started before COVID, transactions by the end of the year, which will be good news, and there will be some others, I'm sure, during the autumn that we will want to study very hard. Costs, of course, are up, and that will have an impact on how people are assessing pricing. Costs with agency staff and with PPE in particular, and closed to new admissions, so occupancy has been affected. But there are some good news stories around the residential care market. 60% of care homes haven't had COVID, and of the 40% that have, very few have been affected very little, and much more affected by not taking new admissions than by COVID deaths. But because of the lockdown and because of the difficulty with the due diligence process in inspecting care homes, transactions have slowed considerably, and we think that that's going to carry on for some months. Although, as I say, where due diligence has been completed, we do think that transactions will happen. And we're not seeing any particular effect on YP or multiple in the sector. The investors and the purchasers are as enthused by the sector as ever. But we will have to reflect in that rebuilding of trade and perhaps some profits reductions over the short to the medium term. In the wider investment market of care homes, I've mentioned primary care. There have been fewer transactions again because of the due diligence process. We're not seeing any particular reduction in pricing, increase in yields as a result of this. But there is a great deal of studying going on around rents, around those operators that are asking for rent reductions and what impact that's going to have overall on the market. And that may affect pricing in due course. We haven't seen any particular yet effect on new rents, but if operational costs around agency and PPE and whatever else demonstrate themselves to be here to stay, then there will be an effect on rent value. I think we have to wait to see a little while to see what's going to come out of that. So I would say yields are still in the 5 to 7% range generally, but there's very little evidence. Adifika's acquisition of the Amt Hill Hamberley scheme at 5.5% is perhaps a demonstration of that, and Target have acquired over this period as well, and things have seemed fairly normalised in that regard. As far as development land is concerned, there is definite caution. There is consideration of what might come forward in the way of land if development in other sectors slows, as it potentially is and will. Does that mean that land values will be lower later? We don't know the answer to that, but there is caution around what investors and operators are buying at the present time. There will be a worry around development cost, around build cost in particular, and how that is built into appraisals. On the one hand, we're hearing that contractors may be less busy, which may be helpful to pricing. On the other hand, we're hearing that developments are slowed and costing more because of social distancing on build sites, not so many building staff on site at any one time, which is pushing costs up. So I think there's plenty to play out there in the way of development and how that might affect development land over the next few months. And of course, operators have been slow to commit during this period whilst they're concentrating on their operations. So moving into the arena of taking on new leases or new care homes has been something that they've put on the back burner for a little while. And if I move on to valuation, the markets, of course, dictate what valuation does. Valuation follows the market, in other words. So we have to be cognizant of what is happening. And that's why I started with transactions and then moved to a few words on valuations. So we've seen the volume of bank valuations down over this period, fewer acquisitions to fund, fewer refinances taking place. But I do detect some tick up in volume this month, and I hope that will continue. I was very hopeful that perhaps not so many people would go on holiday this August, but it seems like everybody went on holiday this August, and I'm hoping everybody is back and raring to go. But operators, undoubtedly, as the COVID numbers have ticked up, are going to be concentrating very hard on what that means for their operations. So we'll have to wait and see just how much volume of work there is around. It's very helpful, I think, that the uncertainty clause has been removed from nearly all healthcare property. It remains for children's day nurseries at the present time, but all other healthcare sectors can now remove the uncertainty clause, and that did have an effect at the outset when funds and banks had to be very cautious with that clause in there. So that is a good news. I hope that doesn't have to come back and that we can continue in the normal way. But I do have to say there will be cautionary words in valuations because of the paucity of transactional evidence. Primary care has held up well, and I won't dwell on that because we have more evidence for that, and valuations in primary care will stand the test of this, I think. But in residential care, I've mentioned it, we will have to take into account short to medium term P&L effects and how that's going to work through. And in the extra care sector, aligned to the residential sector as it is, we are going to have to think with our clients around speeds of sale and speeds of rental, and see how that goes over the next few months to a year. Development consultancy has been busy for us, and if we could just have that slide. Thank you. Development has continued in the primary care sector, and the one thing that I want to mention here, and it allies to what I'll say in planning in a second or two, is that we have seen our first refurbishment of part of a shopping centre for a new primary care facility in Ilford. And I think we're going to see more of those. And my personal view is that that's very good news if we can bring doctors' practices back into town centres and not have them on the edge of town, which is much more difficult for the elderly to get to. I'll mention it in planning terms in a moment as well, but I think that's a significant piece of progress in the primary care sector that I'm quite excited about. We're also seeing funding coming forward for other premises around the UK. So, the traditional standalone surgery premises as well. And I'll come back to that on design at the bottom of this slide again in a moment as well. We're also seeing developments progress in the residential care and the extra care sector as best as they can in this market, although perhaps we're not seeing quite the volume of new starts, but planning consents are coming through. So they're there in the pipeline to be done. But there is clearly pressure relating to planning, timing of planning, the cost of holding while you get planning, the build cost issues that I've already mentioned, and estimating what the world is going to look like in a year or two. When do you start a new facility? Will you have the confidence that if you build a care home that you can start filling it at PC? So all of those things are going to play out, and we've got to look at those. But I did just want to mention design, because it's very clear that at the very outset of the pandemic in March in the UK, people started to talk very quickly about how design may change in care facilities. And we are seeing some of that come through in discussion and actually now with some of the designs that are coming forward. And elements like wider corridors, elements like visitation suites, how you deal with receptions, waiting rooms within primary care, isolation suites in care homes, air conditioning and air exchange systems, temperature checking technology on entering buildings. All of those things are coming to the fore. And in primary care, there is a question around whether doctor surgeries will be as large, whether there will be as many consulting rooms for visits, or whether there will be smaller consulting rooms for online consulting. So there are questions that are coming forward around that. It's very early days, but I think anybody dealing with development has got to start to take hold of that and think about what will be necessary for the future and how much is just short term, or whether we have to design and build for future pandemics. And finally, if I just have a moment on planning before I hand back, we have seen planning authorities performing in various ways around the UK. Some set up very quickly to work from home and perform quite quickly. Some put into place virtual committee meetings very quickly. Others were slower to do that. But we have seen over this period that the majority have now come back in a new way. So I'm very hopeful that planning will be able to continue. And we have seen planning consents being granted during this period. So that's very good news. My personal view is that this should be considered infrastructure and should all be dealt with in planning as important infrastructure, but we're not seeing that at the present time, and we're not seeing that in the August government white paper either, which I think is quite disappointing. There are things in the white paper which are helpful to planning, and the editorial we wrote for the review this year has contribution from my colleague Laura Jenkinson in our planning team as to what the white paper has said with regard to health. And there are a small number of things. The ability of local authorities to borrow against future receipts for infrastructure could be very helpful to the NHS. Hospitals and GP practices may well benefit from deemed planning consent, which may speed things up in the planning arena for them. And medical and nurseries have been put within the new use class E, which is a use class which allows movement between the older use classes very much more flexibly. And that brings me back to the point of the Ilford shopping centre primary care scheme that we're working on, and may be very helpful to moving office or retail uses into nurseries and medical practices in town centres in due course. So that is a very quick run through, and I have one or two closing remarks, but that's a very quick run through of what we're seeing at the present time in the sector. And Jade, if you have the closing remarks slide, thank you very much. I think we remain very upbeat about the healthcare sector as a whole. The fundamentals of this sector are very strong. We all know that. And although we are going through a period of change and a period of worry within the sector, there is no doubt that this sector, in my mind, is going to come out stronger than it went into this in political and economic and social terms. The fundamentals are strong. And let's not forget that the world's economies were closed down for this pandemic. They were closed down for health reasons. It showed that the world thought that health was more important than anything else. And that there can't be a greater endorsement of the healthcare systems than that, in my view. And if investors want to invest in something which is infrastructure, something that has got social conscience, and something that's got longevity, then the UK healthcare system is absolutely a place to be concentrating, in my view. And that's it from me. Thank you very much. Back to you, Henry.
Thank you very much indeed for that, Iain. And just to sort of paraphrase perhaps what you said, I mean, it sounds as if that there's still activity out there in the market, albeit a slowdown. As you just said, the fundamentals remain very, very strong. Valuations and yields are holding up. And there's some interesting developments, perhaps accelerated by COVID, around design, the digital primary care, the locations of some of these clinics and city centres. And then planning remains, I would say, a modest positive with potential upside if the white paper is more supportive. So a very good and interesting overview and summary there, Iain. Thank you very much indeed for that. With that backdrop in terms of the trading performance, next we have Chris Day in a virtual video. Chris has every year talked to us about the state of care, and effectively he's given us a preview of what is going to come up in the state of care. Last year's state of care was really around a focus on people with learning disabilities and the care they were receiving there, the pressures within the system, the desire to have better community care services, desire for care services to coordinate and work better together, and more support for innovation. And I'm really delighted that Chris who wasn't able to be with us, has actually given us a video with his thoughts on what's coming up this year. So I'll just play that for you now, hopefully.
Hello, my name is Chris Day, Director of Engagement at the Care Quality Commission. Sorry I can't be with you today, but I wanted to give you some of the insights in our latest State of Care report, which is due out on the 16th of October. State of Care is our annual assessment of quality of services across England in both health and care. This report covers a time period pre-COVID, if you can remember a time before that, in June, July last year, through to June, July of this year. In the pre-COVID report, we can talk about care being generally good, although there's been little overall improvement in some areas, and we had some real concerns around A&E performance, maternity, and some mental health provision in both the NHS and the independent sector. In previous reports, we talked about adult social care being fragile, and again, the lack of a long-term integrated funding solution and the need for reform, not just in investment, but also in people, means that our concerns around fragility are still there in this report. On top of that, the sector-based funding and commissioning arrangements, and indeed the performance management of the NHS and adult social care, we feel are further structural problems that are impinging the ability of adult social care to improve. Undoubtedly, the massive change around COVID has impacted all of health and care. We've actually been very impressed at the professionalism and the dedication of health and care staff in dealing with this unprecedented challenge. There's been changes to the way services have been delivered, with more flexible approaches to things like GP consultations, and also the way in which both services have worked independently but also worked in collaboration with each other. At the start of the pandemic, decisions were made to protect as many people as possible as quickly as possible, and to focus on acute care driven by an urgent imperative that the NHS shouldn't be overwhelmed. The challenge going forward is to how to keep something of what's been developed, and the best of what's been developed so far, but also to make sure we don't disadvantage others in the process. In adult social care, the artificial distinction between health and care has meant that the coordination that we really wanted to see between health and care services in some cases wasn't possible. Many people couldn't or didn't seek the support they needed, and we think that going forward, the public confidence in both health and care services needs to be built upon. We've seen through our own our work around provider collaboration reviews what difference the integration of both commissioning and the provision can make to how people experience care. And going forward, we're going to put an increasing focus on this in our own work as a regulator. Looking ahead then, as services begin to restart before what might be a second wave, it's important that we look at how services can logistically work better together, but also not returning to the way services have lived in the past. Post-lockdown, the initial lockdown, it's important that we can look at how services have improved and changed as a response to the needs of people. We believe there's some changes that are made to the way primary care operates, but also the way some of the independent sector services operate that is visionary and shouldn't be, we shouldn't seek to go back to a pre-COVID age. Local integrated leadership with local visions supported by funding that happens at a local level, we think are key components of how we bring about a sustainable and equitable health and social care for the future. Thanks for your time. Hello, my name's Chris.
So I think I just managed to navigate the technical challenges there of our first live streamed video. But I think the messages are really very reassuring in a way, in as much as they're consistent with what we're hearing from everybody else. Namely that the sector really impressed and stepped up during COVID, that it's been much more flexible in the way it's delivered services. But more importantly, we need to keep the best things that we've learned from the last few months. And we need to make sure that health and care are better coordinated. So all that I think is pretty uncontentious. Where it will get more difficult is how you make that happen. And I think Chris alluded to the fact that coordination between health and care is around both commissioning, so the people buying these services, and also around delivery. And how that plays out will really impact how the independent sector views it. So on that, I'm going to hand over to William to take us through an overview of the independent sector. I will make some comments about the healthcare sector at the end, and then we'll move to Q&A.
Thanks, Henry. So I'd first of all just like to echo the point about how the independent sector, certainly in social care and elsewhere, I'm sure, has really stepped up to the challenges of the pandemic. And remember, this is a fragmented sector. It's not government directed, but it really did step up extremely well. I think it's not just the dedicated staff that have to be congratulated. I think also it's the senior management as well to be included within those. So I think that's a big bonus. The independent social care sector has demonstrated its capacity to step up to challenges. And I also just make the remark that thank you very much, Iain, for your presentation, because I always enjoy listening to how it really is out there at the cold face. So thank you once again for doing that. So let's just start off by looking at the independent healthcare services market value. What I've done here is to simply take the numbers from the healthcare market review and put them onto a slide which shows the magnitude of each individual one. I've coloured the social care elements in a plum colour, and you'll see that adds up to more than half of the £53 billion that we estimate is spent on independently provided health and care services in the UK 2019. The other big ones being dentistry and private healthcare. You see, there's nothing, the primary medical care is very low. That happens to be because we define, perhaps arbitrarily, the primary medical care sector as being NHS, even though it is provided by independent contractors. Whereas, contrary to that, we define dentistry as being totally independent. And ultimately, that comes down to things like the fact that GPs cannot sell their goodwill. So it isn't a true market in that sense, and various other things. But here we are, about over half of the money spent on independent health care goes to social care. Of course, the big difference there is social care, the independent sector is mainstream, whereas in acute care, generally speaking, the independent sector is not mainstream. The mainstream is the NHS. So let's go on to the next slide if we could. So coronavirus, we have to talk about coronavirus. Obviously, that's the big topic conversation, has been for more than 6 months now. Basically, the care homes for older people, as we all know, have been the most severely affected because, first of all, the age profile of residents, obviously. The death rate from COVID doubles every 10 years, and by the age of 80 or so, it gets really pretty high. Because of the larger scale of care homes, more staff going in and out as compared with, say, adult specialist care homes, which are relatively small. High levels of intimate personal care, whereas in adult specialist care, not so much. And we did some work looking at the ONS statistics. And what we calculated was that the excess deaths during the first wave represented 10% of the customer base of older people's care homes. Now, I have to say that when we're talking about excess deaths, it's not just those attributed to COVID, because if you look at the death rates experienced in the last 5 years and compare that with the COVID period, then we find that the other excess deaths account for another half. So rather than talking about a little bit over 40,000 deaths in total across the whole population, the COVID plus other excess deaths actually amounts to about 60,000, of which over half actually took place within the resident population of older people's care homes, hardly any at all in the younger adults. So I say, the other adult social care markets have been less severely affected. Obviously, they've got costs, PPE, extra staffing costs and so on, but they've been less severely affected. In adult specialist care homes, you have a younger age profile, smaller scale settings, low levels of personal care. In the case of home care, that's interesting. I must say I was expecting at the start of this pandemic that home care would come off very badly because there are large numbers of peripatetic staff going in and out of people's homes. But it turns out that they've been very little affected, and I think that must be down to a large extent to the success of individual home care workers in actually protecting their people they're looking after, And also, of course, people receiving home care are better shielded in the sense that they are subject to a high degree of social isolation. They don't get many visits apart from their carers. So that's just basic background. Now, coronavirus, the additional costs. We've been doing some work for the LGA, for Care England and others. A lot of what we're doing is confidential, so I can't give anything away. Additional costs are still being counted, and largely with a view to seeking additional support. Now, I just heard this morning on the radio that the government apparently has given another £500 million for infection control to care homes. No idea about the details, because I just heard it about an hour ago. And I assume this is in addition to the 600 million for infection control that they've already put in. So what I imagine is that that is a consequence of the lobbying of the trade interests, based on the information that we've helping with on what the actual costs are. Now, say a lot of this is confidential, but what we do know is the major costs, additional cost lines are, first of all, staffing, obviously, the PPE and infection control. But the biggest one by far, certainly for care homes for older people, is lost revenue from empty beds, from reduced occupancy, by far the largest. And for a really clear picture of the additional costs, we'll probably have to wait for publication of statutory accounts. You know, this will be long after we've forgotten about it. Well, not exactly forgotten about it all, but it'll be just a comment on the past, really. And they'll show what the impact has actually been. But we have to wait some time for that. So, impact on excess mortality and occupancy. As I was saying before, the analysis of ONS data shows almost 60,000 excess deaths during the first wave, more than half of them, 32,000, among care home residents, 10% of the entire older people's care home population. Now, obviously, occupancy has taken a big hit, but exactly how it's tracking is rather more difficult to gauge, because we have a whole bunch of data coming at us, and we're not quite sure how to interpret it. A lot of it is anecdotal, and we have to be aware that people out there, to a certain extent, understandably, are being economical with the truth and giving different answers to when different eyes are upon the data. Certainly, if I were a care home operator, I'd be saying one thing to an investor, and perhaps a slightly different nuance to the government if we're looking for extra support. I think one thing that's quite important to put across is that the only data source, supposed data source, on occupancy that has a very high response rate is the NHS's capacity tracker. And we see it from time to time. We can't actually get an official login, I don't know why, but we do get it from various sources, and so we can look and see what it's saying. So it has a 96% response rate, but it gives wrong results. It's giving results which show at least 5% more occupancy than there really is. And speaking to people who are involved in providing the raw data, it's quite clear that what's happening is that care homes are not giving the full number of unoccupied beds. In the same way as often if you're doing a mystery shopper exercise, equally care homes will not tell you exactly how many beds are vacant. And the other thing, so capacity tracker doesn't really help at all. And none of the other surveys really covers more than a fraction of the care home capacity, so may not be representative. Go on to the next slide. So what we think from our own modelling and from other sources, by the end of June, we reckon that occupancy in older people's care homes was down 9 percentage points on pre-COVID. The Knight Frank survey, which has just been published mid-August, shows minus 8%, so pretty similar there. The reason I'm presenting these figures as a drop is that there's a degree of ambiguity about what the absolute occupancy levels mean. This is something I banged on quite frequently before, that you have to know whether you're measuring occupancy as a percentage of available beds or as a percentage of registered beds, and they give very different figures. But if we present this as a drop, then it's, you can have some sort of a reasonable comparison. So 8 or 9% down. And then we just put in a USA comparison. We recently got some data from the National Investment Centre, Senior Housing and Care, which was showing by mid-August -6%. So there we are, something quite similar over in the United States. Let's go on to the next slide. But I think this is, this is one of the most important things. There have been occupancy winners and losers. The work we've been doing, the majority of groups or individual care homes will be reporting occupancy declines. And as Iain says, 60% of care homes have not had any COVID cases. That doesn't mean they haven't had any deaths, because they could well have had excess deaths, because, for example, during the pandemic, very often ambulances were simply not turning up at care homes in the case of people who needed, would normally need hospital treatment. But nevertheless, lots and lots of, there are many care homes, I won't say a majority or a large minority, who have not been affected by COVID, and they're doing, in terms of occupancy, very well. So there are winners and losers, and that's what makes sense of the different messages you're getting from different parts of the sector. And those facilities which, by good fortune, good management, avoided the infections, they're very well placed to take whatever new admissions are available. So that's a big thing. There are winners and losers. I thought I'd also update a chart that we do frequently, which is the numbers of openings and closures. And this to me is very interesting. The green bars on the top are the new openings, and the red bars on the bottom are the closures in terms of capacity. Now, what I've done is to annualize the April to September 20, and you see that both closures and openings are way down. Now, this may well be, it may be because CQC have not kept up as well as they should have done with the official entry of, or official closures. They should have kept up with openings, I would imagine. But even if the CQC figures are fully up to date, there is clearly no big fallout in terms of occupancy, certainly as yet. So I think that's a significant point. Obviously, we'll continue looking at this. So let's go on to the next one. I just want to have a few slides about profitability, really. This just shows the EBITDA margins for older people's care homes, where there's a big difference between private pay and public pay. With public pay profitability from HC1 and Four Seasons generally going downwards, and private pay like Barchester, Avery, staying higher and even improving. Next one is the adult specialist care EBITDA margin. Again, an indicator of going downwards. The odd one at the bottom is Leonard Cheshire, who simply don't run on commercial grounds, but the rest of them do. But they have shown in general over the period of austerity declining margins. And the next one is home care, which is a little bit all over the place, but again, stable to a little bit going down. Of course, these slides will be available to you if you want to scrutinize them. So just a few remarks going forward. Social care market drivers. Demographics, as we know, still positive for all types of residential care, whether it's older or adult specialists. The private pay market looks extremely solid to my mind for the next 2 to 3 decades, because the people with the property are going to be continue, or the present generation of people with high levels of property ownership are going to continue for the next 2 to 3 decades. And unless something really catastrophic happens in terms of values of residential property, the private pay market, which is ultimately funded by property, will stay up. Wider economy, uncertain. Government policy, still distracted. COVID and Brexit. Regulation, I put improving, question mark. Now, labour market, interesting, still negative, because it still remains the fact that there's very high levels of staff turnover within care homes. But there has been a positive impact from COVID, because more people are interested in careers within the care sector than previously, given what's happened to hospitality. And very lastly, COVID accelerated changes. I would say the big thing is the digital integration. I mean, we know roughly that only about 30% of care homes are have some sort of digital care management system. Without this, without other electronic, without any other digital maturity, it's actually hard to see how integration can actually take place between health and social care, because the connections are not there at the moment. But I'm quite sure that that will accelerate as we move out of, hopefully out of COVID in the next 6 months to a year. So that's my summary. Thank you very much, Henry.
Thank you, William. And I think it's interesting to see that the themes that are coming through, both from what you're saying and also from the polls that we had around digital coordination, integration, are all there. Interestingly, we covered Matt Hancock's appearance in front of the Social Care Select Committee the other day, where he's being very tight-lipped about what reform is going to look like. And we know Dominic Cummings has got some plans. He'd like to nationalise everything and have a national care service like they have in Scotland, but may not be able to implement that or indeed afford it. So I think the results of Boris's deliberations over social care, which he's indicated he's going to reveal by the end of the year, will be interesting. And as with many things he does, there may be unintended consequences of some of the decisions that he makes. I just wanted to cover off very quickly the healthcare markets. And really just some themes which I've taken from our healthcare markets journal. So these are articles that Maria Davis writes. If you go to LaingBuissonnews.com, all the headlines are there for free and they're all tagged. But we've seen waiting lists continue to spiral. So we were at 4 million at the end of July, and the 18-week referral in July shows that less than half of people were actually making that 18 weeks. And that links in with some of the questions we had around cancer diagnosis and treatment. The excess deaths that we're likely to see over the coming months are not going to be related to COVID in many circumstances. That 4 million number in some modelling has been seen to go as high as 10 million, depending on how we go with the second wave and what impact that has generally on NHS provision. What I would say though is that when you look at the private hospital activity, we are seeing a significant bounce back. And actually, we've got some really interesting data here, because Health Code, who process £3 billion worth of medical invoices every year, so that's pretty much every privately insured patient in the UK goes through their accounting system. And you can see that the bounce back in activity has gone from 23% 4 months ago to 77% in August. So the independent sector is operating at nearly at 80% capacity now, compared to the previous year. And that strong bounce back, I think, is going to accelerate, particularly amongst the smaller clinics who are targeting private pay patients as well as PMI patients who may have postponed some elective procedures. Just in terms of where the independent sector sits with the NHS, Jeffrey's actually put out a flash note this morning in relation to Spire, who actually had their analyst called 11 o'clock, or have it in 6 minutes time. But they still have an underperform on the stock. Spire's seen significant volume of patients from the NHS. But the question mark has to be where that plays out over the next few years and how that relationship with the NHS changes. So having co-opted the entire capacity of the independent sector at the beginning of the pandemic, the independent sector is now going to be bidding on up to £10 billion worth of NHS contracts. And there's a description here of the procurement. And you can see that it's expected to launch at the end of September and be awarded at the end of November. And again, it will depend on the terms of those agreements, but they are expected to be 2-year contracts with an option to extend for a further 2 years. So I think the independent sector, the way it works with the NHS will fundamentally change. And I think even the likes of HCA, who are central London, complex, premium private pay hospital providers, have worked with the NHS in a way that they have never done in the past. And I hope that some of those themes that Chris was talking about some of the best elements of the interaction between the independent sector and the NHS and local authority provision are carried over. Interestingly, when we ran a poll in one of our previous webinars, is a closer relationship with the NHS in London likely to become political and complex, or a positive for the independent sector? You can see that there is a level of skepticism about whether the NHS and the independent sector will actually be able to deliver this. I think, you know, I'm open-minded, but I note that the track record in the past has been mixed. But I hope also that the pandemic gives a momentum to this that allows us to change the landscape for the good. In terms of individual markets, this was some data that LEK presented, and it came from a survey back in April. But I think what's quite interesting is that 30% of private patients would actually return immediately after providers reopened, and another 30% when movement restrictions are lifted. So that's 60% in total. And that is pretty consistent with the 70% volumes that Health Code are seeing in August. And you can see there is some variation in terms of the appetite to return immediately, depending on what type of treatment it is. So I'll just highlight that IVF, 45% of people would seek to return immediately. And that's natural because it's a time-limited procedure. Whereas in ophthalmology, it's down at 24%. Hair transplants are even lower at 23%. And some of these are more optional electives. But I think the data is pretty consistent around that 60–70% level. So what does the future hold? Short term, there's clearly a PMI backlog, and the insurers have effectively not been paying out, but collecting your premiums. Interestingly, if you saw Bupa's first half results, they're down 28% in terms of profitability, but their solvency margins actually went up because they are hoarding cash from those premiums and not paying them out for procedures. So that PMI backlog will start to unwind, there's no doubt about it. On self-pay, probably a lag. And I think there's a question whether people can convert inquiries and persuade patients to come into their clinics. International, I think medical travel is very much suffering until the airlines and the airports can have a system which doesn't require 2 weeks quarantine, but also maybe is linked to testing, which is playing out in the press as we talk. And then the PPUs, because of their reliance on some of those patients, that may be more vulnerable. Medium term, I think it's more mixed than for elderly care. It's not underpinned by what William was talking about, that wall of money in real estate that will underpin the private pay market, combined with demographics, which are very, very compelling. So I think there's potentially more downside than upside. It will matter about what happens globally. It will matter what happens in the UK around Brexit. PMI is linked to jobs, and people's willingness to pay out of pocket is linked to their perception of wealth, where the stock market is, where house prices are, where inflation is, where employment is. So I think patient confidence, no second wave, no bad winter flu, no COVID outbreaks in a private hospital, and we can be much more positive, but there are a lot of ifs there. And then if we look longer term, PMI, there's potentially more pressure around pathway management to contain costs, which may not be good for the providers. Self-pay, consumer confidence is important, but we saw those NHS waiting lists. That's also going to be a key driver of volume. International, we need to see where travel gets to, but also things like oil price. So I don't know if you saw BP have come out and said they're going to be carbon neutral by 2050. They think we've already seen peak oil. Alternative energy is going to be the future for them, BP, beyond petroleum. If that is true, then the Gulf states, who represent a significant portion of international patients into the London market, they are going to be capped by where the oil price is and their willingness to pay. So I think there are more variables in the independent hospital market, and particularly in the London market with that international exposure, than with social care. And hospital profitability as well has again seen continued pressure. Longer term, would there be changes in the tax environment? PMI is heavily taxed at the moment. Will there be changes driven by technology with remote consultation and a shift to out of London diagnostics or virtual diagnostics? Will that expand the market? And how will consultants adapt to being in employment with the new models being rolled out, particularly by Cleveland, but also Schön Clinic. So who knows where we will be in independent care? I think we will get more clarity over the coming weeks and months. But to a certain extent, I think there is a higher level of uncertainty about market outlook in independent care than there is in social care. On that, I am going to now go back to the poll and just see whether we've had any material changes. So I think we are looking at integration on the right terms, which again is consistent with what we've heard from the panelists. But now I think we'll just go to Q&A. And I'm going to start with the top voted question here. Within elderly care homes, what do you project as fee growth for private and public pay in a COVID recovery environment? And I think that's a really interesting story because the whole market is around fees times by occupancy. And we've talked about occupancy quite a lot. But William, I don't know whether you want to perhaps start on that in terms of where you see the outlook for fees, both for private and public.
Well, as far as public goes, we'll have to talk about 200 different answers, and there isn't time for that. In fact, more than 200, because another 100 from CCGs, all of which are different, 135 for them. A lot of, look, it's all varied out there. A lot of local authorities have been responded quite positively and given either temporary or permanent fee increases. Others haven't. It's always also tied up in how much is being given out to care homes in recompense out of the existing fund, which is essentially a temporary one. But ultimately, obviously, costs are rising and therefore fees will have to rise. I wouldn't like to give a prediction as to how much it will have risen by the end of this financial year, but it'll certainly be, even at public pay, it'll be a lot more than in the past. As far as private pay goes, I see no end to the private pay premium, which is over 40% compared private pay with basic local authority pay. And until something very serious is done from Boris Johnson and Dominic Cummings or whoever, that will continue.
Thank you, William. Just to remind everybody who's online, we've got nearly 300 of you. If you want to ask questions, if you just put them through Slido, and then we can put them over to the panelists. On that, we've got, Iain, a question for you here about your views on current investment yields for new assets in the elderly care sector. We're still seeing new build out there. Are they being differently valued perhaps to some of the legacy assets, even the purpose-built ones?
Yes, they are, and modern purpose-built with all the latest, well, they might not be the latest facilities now if we're going into a new design regime, and actually there could be a yield shift for those new design contents as they come through as well. But yeah, views on current investment yields, look, it varies. It's in what I said, I think is generally the 5 to 7% range, with some of the larger operators perceived as better covenants possibly still being sub 5%. And as I said, I don't see that there's been much yield shift in the market, although there's a paucity of evidence perhaps at the present time.
Thank you very much for that, Iain. William, a question on what we mean by health and care integration. And we heard from Chris Day that the CQC think it's a good idea. I guess the practicality of what that means on the ground, whether it's empowering ICSs, whether it's empowering a single organisation to commission services across health and care. There are a lot of different models out there. Do you have any sense for the direction of travel?
Well, the NHS is absolutely, well, the policy is absolutely clear. It's ICSs coming out of STPs, and that will continue over the next couple of years. But what I would say is that integration is not integration of budgets. It may be one of the necessary conditions, but certainly simply by joining up budgets, you don't get there. Scotland has done this. They have a joint authorities. Northern Ireland as well has a single authority. That doesn't mean that they're integrated, because in order for integration to take place, it has to be at a very granular level. In order for that to happen, I think it has to be possible for the individual elements of that integrated system to actually talk together digitally.
And I guess a sort of follow-on question to that, William, from Phil Eckersley here, where joint commissioning is being put in place with the NHS and local authority, have providers seen that that is actually a way of putting pressure on fee rates, I assume he means, i.e., by combining the two, is that a way of actually taking cost out of a system which is already struggling with current local authority fee rates?
Right. Well, I mean, this is happening both formally and also informally, because we have the CCGs have been merging, took place at the beginning of the year, and we're actually working on one or two commissions in which the local local authorities and CCGs are attempting to achieve some sort of consistency in fee levels. I think, unfortunately, in those areas which are hard pressed financially, that will have an impact in a downward direction. It will all depends on how flush each individual health economy is with money.
A question for you in a future of supported living real estate. And I think, we've seen both Civitas and Triple Point be extremely active in this sector. And although it's not affected by COVID, the question says no considerable investments by REITs and institutional investors. So I guess in the context of, say, the care home market, maybe just having those two REITs doesn't move the needle. But do you feel that there is more capital and more interest in terms of where you're getting inbounds for this particular sector in supported living real estate?
Yeah, in the sector overall, very definitely. And when you look at the REITs, institutional investors, and the private equity that's been looking at other areas of beds, and it tends to be called the beds market, and the healthcare sector gets put within that. There is rising interest with supported living real estate as well. But these sectors are quite different one to another, and although they're based around beds, the size of the asset, the distribution of the asset, and so on is different across sectors, and how you invest is slightly different one to the other. But I would say that there will be more interest and there will be more investment for the supported living sector over the next few years.
William, we've got a question here which is very much for an economist. With the UK government printing money at the moment, do we risk inflation, and how do we think this will affect private payers? And we had a comment from another of the audience saying that their view was that a swift rise in inflation leads to a negative impact on property prices and therefore a negative effect on private payers. But I think this loose monetary policy that we're seeing at the moment, I mean, interestingly, inflation dropped last month as a result of the Help to Dine strategy. But do you think this could impact where the private payer is over perhaps the medium term?
Well, it's possible, but I thought that you can always inflate yourself out of a recession, and that increases asset prices generally. So that would actually have a positive impact on valuations on the value of property to pay for long-term care. But I think the government, I very much hope so, will be very much guarding against that. That's the last thing we want to do.
Very good. And I think just there are a couple of other questions here with 2 votes. If we wrap up with those. So on the basis of recent directive to limit discharges from hospital to residential care, does Whitehall have an agenda to reduce the number of residential beds? I have to say I'd be surprised if Whitehall has an agenda to do anything, but I'll let you answer that. And do you, William, have any views as to whether we've seen any correlation between the prevalence of COVID in care homes and care home size and or design? I think you did touch on that a little bit in your presentation.
Yes, I think it's reasonably well established, certainly at an anecdotal level, that that size does have an effect. The larger the care home, the more likely they are to have a COVID infection. As far as design goes, I mean, Iain mentioned new design features like things which take temperatures as people come in, but it's too early days to tell whether that has an impact in practice, because not many care homes are built to that sort of specification. But certainly size, it does have an effect.
And Iain, I don't know if you have any thoughts on that, particularly from a design perspective, or whether you've seen any stats during lockdown.
No, haven't seen anything that helps, I don't think. I mean, we do know, of course, that keeping people in their own home is a cheaper way of looking after people than in care homes. And I wonder whether, you know, there will be perhaps more funding coming forward for fees for residential care beds, but there will be a push to keep people in their own homes for longer as well, I think. How that plays out, I don't know.
Very good. I mean, interestingly, in the conversations we've been having with chief executives in terms of COVID outbreaks and the type of home, the number one driver appears to have been actually high levels of community transmission of COVID. So if you just happen to be with a care home in a community with COVID, then unsurprisingly, you're more likely to get it in your home. I think secondly, there's an element of the size of the home. If you've got more people coming in and out, although one CEO is saying that actually there's a strength in having a large home because you can actually isolate a floor, for example, so you can manage it better. I think having high levels of dementia care is another strong driver because it's very difficult to manage dementia sufferers without touching them. So it's a sort of practical measure. And then, frankly, the biggest drivers are probably access to PPE and testing. And I think testing really is the key one. And we've seen the testing environment at the moment where we're having delays of several days before you get the tests back. There was one care home was saying they actually they send their tests off weekly, and they were sending this week's test off before they got the results from the previous week. And clearly, if you've got somebody who's asymptomatic or indeed has COVID, but you don't know that, and they're working in the home for several days, that doesn't really help you manage what you're doing. So I think there are lots of challenges out there, but I think the backdrop is very much that of a very positive sector, but one which clearly has some near-term challenges. So I'll just sort of close on that poll and thank our panelists and our audience for participating. This has been covering a lot of ground. But Avison Young have been very good supporters of this report for many, many years. And our charity partner turned to us, which also works closely with the Care Workers charity. So on that, I'd just end by saying we have a virtual conference coming up, which is going to be on the 8th of October. And it's around the private acute healthcare market, which I think you've heard during this webinar is the one where there is perhaps more uncertainty, both in terms of upside and downside. And then on the 13th of October, we have our social care conference, which at the moment is a socially distanced in-person conference. But I think in the next few hours, we need to make a call there and is likely to go fully virtual. And I will be interviewing Jeremy Hunt, and it'll be very interesting to see what he has to say. So on that, thank you all very much indeed for attending. And we look forward to seeing you at our next virtual event in this new COVID world.
Thank you very much.
Thank you.